The spotlight is on Reserve Bank Governor Lesetja Kganyago, who will announce the bank's latest monetary policy decision next week. With the second wave of the COVID-19 pandemic sweeping across South Africa and the move to lockdown level 3, the outlook for 2021 is already worrying. The economy is now widely expected to contract in Q1, with overall growth for the year subdued. The bank has constantly said that all future decisions will be data dependent, and any significant shocks to the economy from the second wave of the pandemic could see it push out the hikes and hold the benchmark rate, especially if it trims its inflation forecast further. Chief Economist at the Bureau for Economic Research, Hugo Pienaar, joins us for the preview. Hugo, thank you for your time and thank you so much for joining us on Weekend Dawn. The way things look at the moment with level 3 lockdown, we're still dealing with a second wave of COVID-19. Does it seem as though the interest rate will remain unchanged over the next few weeks or maybe even the next few months?
Good morning. Well, that's certainly the consensus expectation at this stage, that the Reserve Bank will, for the foreseeable future, keep the policy rate unchanged, as you suggest. There are a couple of economists, including ourselves, that actually think that we could see a bit of a surprise next week, where the Reserve Bank could actually decide to cut the repo rate by a modest, or a further, I should say, 25 basis points, largely in response to the growth risks for South Africa at the start of the year.
Is there room for another interest rate cut in the next week?
Well, we think so. Inflation is certainly not an issue at this stage. So yes, there are some risks. The oil price has picked up. We're seeing some food price pressure have emerged. But in general, the Reserve Bank, or the inflation expectations remain subdued. And the outlook is that the targeted inflation will remain well within the Reserve Bank's target band in the foreseeable future. So from that perspective, I think we do have some scope.
Hugo, let's look at beyond COVID-19, beyond the second wave, when we finally have this pandemic under control and the economy obviously starts growing again. Can we expect then in the next year or so a very steep interest rate hike?
No, I wouldn't think so. I mean, I think the Reserve Bank would, again, if there's no inflationary pressures really emerging, I see that no reason why they would need to be aggressive. And also, if you look at the forecast for growth in South Africa, even over the next 12 months, it's not like we're talking about booming times. Yes, we set for a recovery, but there are still numerous risks from Eskom, from second wave, etc. So I think they will probably take a fairly cautious approach towards tightening monetary policy over a 12 to 18-month view.
And what will be the key drivers of our economy actually recovering and getting back to the levels of, 2018, 2019?
Well, of course, one looks at the rest of the world. We are a small open economy, so we are quite export dependent. So if the rest of the world starts a recovery from COVID, that will help us. But of course, I think it's all about what happens domestically. And again, one comes back to COVID. We are concerned about our vaccination program. We're certainly lagging what is happening in the rest of the world. So many countries have already started their rollouts. So I think that puts us on the back foot in terms of managing the virus. And then, of course, we're in the midst of another round of Eskom load shedding, of course, which sort of emphasizes that the pre-COVID growth constraints in South Africa have certainly not gone away. So if you throw all of that into the pot, it tells you that, yes, we are set for a recovery, but our recovery may actually lag what we see in other parts of the world.
And then if we look at the current very low interest rate and maybe another interest rate interest rate cut in the next week or so, what are the advantages of that for the average consumers, for you and I, this current low interest rate? Because it is an all-time low, if I'm not mistaken.
Yeah, it's certainly the lowest in a number of decades. So of course, it's mainly for people that have debt, right? Whether you have a mortgage bond or a vehicle, monthly installments, etc. The cost of those repayments, of course, have now gone down quite substantially over the last 12 months. So it does add to the disposable income of consumers. If you then think that many people, for example, are traveling less to work, those of us that can work from home, so you're saving on the petrol as well. So that combination, it can't make up for some of the income loss that unfortunately many people have suffered, but it does play an important mitigating role to support disposable income.
All right, Hugo, we'll leave it there. Chief Economist at the Bureau of Economic Research, Hugo Pienaar, chatting to us about the first Reserve Bank monetary policy meeting set to take place next week. An announcement on interest rates is expected on Thursday. So we'll, of course, look into that again next week on what that means for the average consumer and what that means for South Africans, especially during the COVID-19 pandemic, as we all battle this second wave.